and welcome to TK Services. So today I'm going to be doing reading number 33, study session number 10 under the subject corporate finance, cost of capital. Again, a reminder, this is for the CFA level 1 students. The topic, as I mentioned, is going to be cost of capital, and the coverage of the topic is going to be as under. I'm going to cover the cost estimation and weighted average cost of capital, the relevance of beta, that means the asset beta, the project beta, the equity beta, and all of that, and what is marginal cost of capital and how is it so important in the cost of capital uh, calculations and concept rather. So let's start therefore with the cost estimation. Now there are three different types of sources of funds which we'll be looking at: debt, preference, and equity. What I have done is I have told you how to estimate the cost for each component. So when we talk of debt, effectively when we are actually calculating WACC, we take the post-tax cost of debt, because let's say $100 face value bond has an annual coupon of 8%. Effectively $8 of interest is charged to the P&L, and let's say the tax rates are 40%. So for every $8 that is charged to the P&L, it saves tax by $3.2. The effective cost of capital, or rather the effective interest obligation, is just 4.8% rather in this case. Therefore, it's so easy to say and understand that the effective cost of debt is basically interest into 1 minus tax rate. The question is, which value should you take as interest? We should definitely take YTM, or yield to maturity, and the fastest way to compute yield is by this formula. Yield is basically C plus M minus P by N by 0.4 M plus 0.6 P. Now if you look at this formula carefully, it has actually broken up your investment into two parts. 40% of weight it is assigned to the maturity value, 60% weight is attached to the price. So if this is your investment, this is actually your total return, which is in terms of a fixed return or coupon, and this is your appreciation or depreciation in the value of the bond. So the total return upon investment is basically computed as yield. We should definitely use yield to maturity, use that yield to maturity and convert that into post-tax cost of debt, and that is what is relevant for WACC calculations. Now as far as preference shares are concerned, it is fairly simple. All you need is basically the dividends that are payable on the preference shares, and if that is divided by the present price of the preference shares, that should give you the cost of preference shares. Again, a simple concept and extension of the return on investment calculations. Finally, we come to equity. Now there are two models that you typically use for equity, cost of equity calculation. The first model is basically the Gordon's constant growth model, and as per the Gordon's dividend discount model or constant growth model, P0, or the present price, market price of the share, is equal to D1, which is the dividend forecasted at the end of the first year, divided by KE. KE is the cost of equity minus G. G is the growth rate, or where G is rather, it depicts the growth in the prices and dividends of the shares. Now if you want to solve for KE, it is fairly simple. KE translates to be D1 by P0 plus G. So this is how you estimate cost of equity as per the Gordon's constant growth model. The other way to estimate cost of equity is basically subscribe to the capital asset pricing model, which is basically saying that cost of equity is basically your basic minimum return, which is a risk-free return, plus the proportionate amount of risk which is commensurate, a proportionate amount of return which is commensurate to the risk being taken if you are subscribing or endorsing or investing in an equity security versus a debt security. So that, friends, if you use the capital asset pricing model, cost of equity becomes risk-free rate plus the beta multiplied by the incremental market return over and above the risk-free return. So this risk is basically the risk-free rate, and this beta is a measure of systematic risk. So if you add this commensurate level of return proportionate to the risk being taken to the risk-free return, that is what an investor will typically expect if he invests in an equity security compared to if he would have invested in a risk-free security. So these are the methods in which we compute the costs of the various sources of capital, debt, preference, and equity. Now let's try and actually understand and apply the concepts. So what I have done is I have got you a problem. This is a very important problem which helps you understand how to compute weighted average cost of capital. Now what is given here is this is the capital structure of ABC Limited, which has equity shares, retained earnings, debentures, preference shares, term loans, and capital employed. The face value of the securities is given here, and the number of shares or securities outstanding is given here, and this is the total capital. Then you are given information about equity shares trading at 150, expected to declare a dividend of 7.5 per share in the next period, expected to grow at 8%. Debentures are trading at 120, have 10 years to maturity. Preference shares are trading at 90, have 5 years to maturity. Assuming corporate tax rates to be at 30%, let's estimate the weighted average cost of capital. For the cost of equity, we will use the Gordon's constant growth model. You are seeing that the expected dividend is 7.5. Expected dividend is nothing but D1. The current market price of the equity share is 150. So 7.5 upon 150 as a percentage gives you 5%. You can see that in the formula here. Plus G. G, the growth rate is given to be 8%. So 5% plus 8% will give you 13%. So 13% is therefore the cost of equity. Now let's compute the cost of debt. The cost of debt can be simply obtained by the formula C plus M minus P. So C is your annual coupon. So if your debentures are at 8% and the face value is 100, the coupon is 8. So 8 plus the maturity value, which is 100, minus 120. So debentures are currently trading at 120. So you reduce the price, divided by N because you have 10 years to maturity, divided by 0.4 of M, 40% of the maturity value, which is 40, plus 60% of the price, which is 72. So if you take this and compute, your YTM comes to 5.36%. Now, even though it is 5.36%, what you should be considering is the post-tax cost of debt. So we will multiply this by 1 minus TR, which is 1 minus 0.3, since the corporate tax rates are 30%. And we get the post-tax cost of debt to be 3.75%. Note, if we would have taken the cost of debt to be 8%, which is the coupon, we might have wrongly estimated the cost of debt, because even though the coupon is 8, given the current prices of the debentures, the effective cost of debt is only 5.36%, which is measured by yield to maturity. And when you take the tax effect, the net after-tax cost of debt is actually 3.75%, which is relevant for WACC calculations. The cost of preference shares can be found out by the same formula, because you have been given the prices of the shares and the number of years to maturity. So we will use the same. Instead of coupon, you will use dividend plus maturity value minus price divided by number of years to maturity. All of that divided by 40% of the maturity value and 60% of the price, giving you the cost of preference shares of 12.77%. One very important concept in weighted average cost of capital is the fact that when you are computing weighted average cost of capital, you should always take the market value weights. Very, very important, because all your yields are actually calculated reference your market price of the securities. So we must use the market value weights. Now, what is the market value of the debt? If you see here, we have 12,500 debentures, and each debenture is trading at 120. So the market value of debt is 15 lakhs. Now on the preference shares, there are 2,500 preference shares, each is trading at 90. So the market value is 225. As far as the equity shares are concerned, there are 1 lakh shares, each trading at 150. So the market value is 1 crore 50 lakhs. And the term loans is taken at book value, which is 35 lakh rupees. So all of these are taken, and the total market value of all the sources of capital is 2 crore 2 lakh 25,000. What we do is we find out the weights of each in the total capital portfolio, which is nothing but, for example, the weight of debt will be your debt market value by total capital. Similarly, if you want to compute the preference, it is the market value of the preference shares divided by the total capital. Similarly, for equity, it will be the market value of equity divided by total capital portfolio. This way, you get the weights of all the securities, and then you multiply this by the cost of each security which we have computed above. Okay, and for term loan, all we need to do is the 9% term loan. We need to take the after-tax cost of debt 9% into zero point 0.7, which is 6.3%. Now, when you multiply sigma WK by sigma W will always be 1. You can see that here. So sigma WK, where K is the cost. So 0.074 into 3.75% plus this into 12.77% plus this into 13% plus 0.170 into 6.3%. You get the weighted average cost of capital of 11.15%. Now this gives you a fair idea of how weighted average cost of capital is computed for a particular organization having various sources of capital divided or bifurcated into equity, preference shares, debt, and so on. Now we come to another interesting concept, which is the concept of beta. Now beta, as you know, is a measure of systematic risk. Now systematic risk is something which you cannot diversify, right? Or you cannot remove by diversification. So as far as the beta is concerned, how is that relevant? Now let's say you are valuing a particular organization and you want to use the capital asset pricing model. Now you must use the beta which is specific to a particular project. Now, if you do not have the beta for that project, you can take the beta for a comparable, the levered beta, and then unlever that beta. Whenever you need to unlever the beta, you need to divide by 1 plus 1 minus TR into debt equity ratio, where TR is the tax rate. Once you get the unlevered beta, you can multiply this by the lever for the project, the specific lever for the project, and the specific lever for the project will be 1 plus 1 minus tax rate applicable to the project multiplied by debt equity ratio for that particular project. In that way, you can compute the levered beta, and then you can use the levered beta in estimation of cost of equity for that particular project, and then go on compute the weighted average cost of capital. Let's now consider a small example. XYZ Limited is contemplating a project in the food business. It has a debt equity ratio of 2 and a tax rate of 40%. The debt currently yields 14%. A comparable ABC Limited is operating only in the food business and is a publicly traded firm having a debt equity ratio of 1.5 and a tax rate of 30%. Its equity beta is 0.9. Risk-free rate and market return has been given to you. What we need to do is first find out the unlevered beta. Now the equity beta of the publicly traded firm is given, which is 0.9. So we will first unlever the beta by dividing by 1 plus 1 minus tax rate. The tax rate is 30% multiplied with the debt equity ratio of the publicly traded firm, which is 1.5. So you unlever the beta and bring it down to 0.439. Now this is the comparables asset beta. When you unlever the beta, you are converting the beta from an equity beta to an asset beta. Now we use this beta to arrive at the levered beta for the particular project. So what will be the levered beta? The levered beta for that project, you can use this particular beta that you have found out, the unlevered beta, and multiply it with the project specific factors. Now for the project, you will observe that the tax rate is 40%. So we will do 1 plus 1 minus 0.4 multiplied by the debt equity ratio. And for the project, the debt equity ratio is contemplated or envisaged to be 2. So we multiply by 2, and you see that you get a higher equity beta for the project simply because of a higher risk, having a higher debt in the capital structure. So because of higher leverage, you are getting a higher equity beta for the project. So we have now arrived at the project's equity beta. Now we will use this particular beta to estimate the cost of equity for the project, which is nothing but your risk-free rate using the capital asset pricing model. Risk-free rate of 5% plus your beta, which is 0.966, multiplied by RM minus RF, where the return on the market is 12 and the risk-free rate is 5. So the differential is 7. So we multiply this by 7%. So this is how you compute the cost of equity for the particular project. All we need to do now is to find out the weighted average cost of capital of the project. Now you know that for the project we have kept the debt equity ratio to be 2, which means the proportion of debt is 2/3 and the proportion of equity is 1/3, or 0.667 for debt and 0.333 for equity. For debt, since the debt yields 14%, we will take the after-tax cost of debt. So 14 into 1 minus 0.4, which is 14 into 0.6, which is 8.4% for your cost of debt. Cost of equity is taken to be 11.76%. Weight multiplied by cost for debt plus weight multiplied by cost for equity will give you the weighted average cost of capital for the particular project in hand. So this is how you can apply the concept of levered beta, unlevered beta, how you can unlever the beta and then lever it back using project specifics. Go on to estimate the cost of equity and then go on to estimate weighted average cost of capital for a particular project using the project specifics and comparables. Now we come to the last part of this particular study session, reading rather, which is the marginal cost of capital. Now let's say a bank has offered these terms. I'm going to shade them in a different color so that it's easier for us to refer to. So here it is. So if you issue, if this particular organization issues new debt, up to $99 of debt, the cost of debt post-tax will be 4.2%. Up to $199, it's 4.6%. Up to $299, which is 5%. Similarly, for equity, up to $199, it will cost them 6.5%. Up to $399, it's 8%. Up to $599 is 9.5%. Why is this important? See, what happens is when the organization raises funds, depending upon the volume of the funds infused into the organization, the source of fund, the cost of capital can vary. What we are trying to do is we are trying to stitch these costs of capital together and try to see if the WACC changes for every change in the capital, and that is called the marginal cost of capital, or the cost of capital for every incremental borrowing that the company does. So let's find out the break-even points. Now, the way we are going to find out the break-even points is, if you look here, up to $99 is 4.2. So that means the moment the debt increases to $100, the cost of debt will change. So this is the first break point, not break-even, break point. The first break point, therefore, is $100 of debt. Okay. Now, you are going to have a debt equity ratio of 1.5, which is decided. So that means, or rather, not 1.5, 1 by 1.5. So equity is 1.5 times the debt. So I am going to take 2:3 is your debt equity ratio, sorry. So basically, the equity will be 1.5 times the debt. So equity is 150. So the total capital is 250, and this is the break point for the debt. Now, next, the moment the equity touches 199, so which is basically 200, the cost of equity will change, and the cost of and the debt will therefore be 1/5 of that. So 2/3 of this. Okay, not 1/5, divide by 1/4. So basically 2/3 of equity, since you are maintaining a debt equity ratio of 2:3. So this is your debt. Now here we have a break point of equity, and therefore the total capital is 333.33, where if you look at the 2 by 5 multiplied by 333, you get 133.33, which is debt, and 3 by 5 multiplied by 333.33, you get 200 as equity. So basically this is your total capital, but mind you, now we have taken the equity to be 200. At $200, the cost of equity will again change. If you look here, it changes again to 6.5%. Because it changes here, this is also a break point for equity. Now we again come to $200 of debt. If you have $200 of debt, you again change from 4.6% to 5% of cost of debt. And therefore, if the debt is $200, the equity will be 1.5 times this, and therefore the equity is 300, the total capital is 500. And then when the equity touches $400, then the equity cost again changes from 8% to 9.5%, and the debt is 2/3 of this, so that is 266.67, total capital 666.67. what we are going to do, we are going to find out the weighted average cost of capital for 5 different capital structures: 100, 250. 100 is basically, if the total capital is 100, the debt has got to be 40 and the equity has got to be 60. So you are in the first slab. Then the first break point, total capital 250. Second break point, total capital 333. Third break point, total capital 500. Fourth break point, total capital 666.67. We divide this between debt and equity, right? And then we find out the appropriate cost of debt. Now $40 is the first slab, so you will have cost of debt 4.2. $60 is also first slab, so cost of equity 6.6, and you compute the weighted average cost of capital by just multiplying the debt value with the cost of debt and equity value with the cost of equity, and then divided by the total debt and equity. When the total capital is 250 and the debt is 100 and the equity is 150, the moment the debt is 100, you have crossed your first break point, and now the rate cost of debt applicable to you will be 4.6%, which is here, whereas the cost of equity will remain same, leading to a higher weighted average cost of capital. This is the concept of marginal cost of capital. As your thresholds of borrowing are breached, you are incurring incremental costs of capital. So again, the concept will be 100 into 4.6% plus 150 into 6.5% divided by 250 will give you your weighted average cost of capital. Now we move to the third break point, which is 333.33. Okay, now in 333.33 you have $200 of debt. So now you will $133.33 of debt. So you still remain in the same debt structure, 4.6%, but $200 of equity. Now you have breached the level, so you now reach at 8% of cost of equity. So again, your marginal cost of borrowing will increase and your WACC will now be stationed at 6.64%. Next break point is at $500 of total capital structure divided into $200 of debt and $300 of equity. Now the moment you have $200 of debt, you have finally reached the last level of the cost of debt, and the cost of debt applicable to you will be 5%. $300 of equity will still remain at 8%, and then you have got a higher marginal cost of capital with the increased borrowing of 6.8%. You come to the last break point where the total capital is 666.67, debt 266 and equity 400. 266 falls within this category, so the cost of debt remains at 5%, but cost of equity now crosses $399, and therefore the cost of equity crosses 9.5%, and therefore you arrive at a weighted average cost of capital of 7.7%. Now you see, where you are increasing the borrowings, there are breakpoints which kind of suggest a switch in the costs of borrowing because of higher costs, and those switches basically tells you the incremental cost of borrowing when you're moving from one capital structure to another capital structure, infusing higher amounts of debt and equity and incorporating higher costs based on ranges that are given to you. This concept is called as marginal cost of capital. So now if you go back to the slide which talks about the coverage, so we have covered the estimation of cost using all the models for all the sources of funds, which is debt, equity and preference. We have covered the weighted average cost of capital, we have covered the relevance of beta, and we have covered the marginal cost of capital. With this, we complete reading number 33, study session number 10 for CFA level 1 students under the topic corporate finance, subtopic cost of capital. I wish you a happy reading. You will see the teaser on my YouTube channel, and you are free to subscribe to my channel for detailed sessions as I have explained to you. Thank you so much and take care.